Welcome back to Finance for Firefighters, and today we're going to talk about cost segregations and how it applies to real estate and bonus depreciation. What is cost segregation? So the IRS allows you to depreciate rental properties, at least residential rental properties, and regularly in 27.5-year periods. But using a cost segregation study, they're allowing you to get a company to come in and split that building up into parts, right? The government doesn't allow you to write off the land, but it allows you to write off the depreciation of the building itself. And certain parts of that building depreciate faster than other parts. So a cost segregation study is an IRS approved ability for you to write off those smaller parts at a faster rate. And if you combine that with the bonus depreciation, which is now in effect for the near short term, you're going to be able to use both of those to be able to write off a higher amount of that property much faster than the normal 27.5-year period. Let's look at a couple of examples of how to break that building down into its components. So we break a building down into components with shorter lifespans. This includes things like appliances, flooring, cabinets, HVAC, electrical systems, things like that. So instead of depreciating the entire building over 27.5 years, many of those parts are written off in 5, 7, or 15-year periods. So if you combine this with bonus depreciation, you can deduct all of it in a year. You don't need to be a real estate professional for your short-term rental to qualify. You just have to meet a couple of different things, like we talked about in the episode before. So 7 days or less for a short-term rental property, and you have to materially participate. So if we go back to the previous episode, we look at that property that the firefighter bought in Dallas, Texas for $375,000. They use it as a short-term rental. Well, we're saying that the house is worth $300,000 and the land is worth $75,000. You can't write off the land, but you can write off the depreciation of the home itself. So if we take that $300,000 of that home and we take approximately 25% of that, which is on average what a cost segregation study would show, they'd have approximately $75,000 of depreciation that they can write off. And if they meet certain qualifications, they can use that to offset their W-2 income. So the material participation and the short-term rental status. So let's look at the timing and eligibility of this. So for timing and eligibility, the property must be placed in service during the tax year. You must materially participate. So you have to have the hours in the record keeping as part of that. The bonus depreciation is currently 100% through the One Big Beautiful Bill Act. And you need to use a third-party firm or a cost segregation study. And usually cost-wise, depending on where you live, is between $3,000 to $5,000, which sounds like a lot of money, but it's often worth it. So if we use the firefighter example like we talked about in the previous episode, we're saying that modified adjusted gross income of that firefighter is $150,000. And they were able to write off about $75,000 of that bonus depreciation. Even with $24,000 of income coming in from that short-term rental, they're using that to lower their taxable income significantly. So they're brought down in lower tax brackets and they're effectively taxed significantly less during that period of time. So depending on their withholdings, they could save anywhere between $15,000 to $20,000 in federal income tax just by using the depreciation. A couple of questions. Can I carry forward unused credit? The answer is yes. Can I forward unused losses? The answer is yes. Can I do this again? The answer is no, unless you buy more properties. And then the answer is yes. What disqualifies me? Long stays, third-party management, or weak documentation. Does the land qualify? The answer is no, because the land doesn't go bad, the house does. So you can only rent off the value of that actual structure. So the short-term rental loophole with a cost segregation study and bonus depreciation is a huge legal tax loophole to allow you to slingshot yourself forward financially. Thanks for joining me on Finance for Firefighters. There's a quick guide in the description below. Give a thumbs up if you like it. Any feedback that you have in the comments section. Hope you guys have a good shift. I'll see you in the next one.